An apartment investor defaulted on 229 million in loans across four properties in Houston. The lender foreclosed on 3,200 units when the group could no longer make the mortgage payments. And this group is not alone. Some investors will conceive future opportunities, while others may fear that they could be next. Understanding what went wrong and assessing the risk is critical here. Real estate investors are generally optimistic people. When investors acquire the portfolio, they believe they could increase rents, drive NOI, and sell at a profit. Fortunately, less than a year after acquisition, they were handing the keys back to the lender. Negative cash flow is the biggest threat to any real estate deal. Income minus expenses is the net operating income, but cash flow is what is left of the NOI after subtracting debt service and capital expenditures. As investors, we must understand the projections for each of these items and recognize where there may be risk or vulnerability. Income. Investors look for high income properties to cover expenses, debt service, and capital expenditures while still delivering favorable terms. Rent collection can be problematic, especially for lower class assets. It's important to conservatively project future income and occupancy to mitigate risks. Expenses. Operators assume expenses will remain flat from previous ownership, but insurance and taxes may increase. It's critical to ensure the expenses are based on, expert consultation rather than using your future business plan and not a T12 from the seller as is. Debt service. Interest rates, terms, loan to value ratio, and prepayment penalties are factors to consider. You need to select a loan that matches the business plan and the risk profile for the project. CapEx and reserves. A value add strategy such as the one we're talking about requires a hefty CapEx budget to deliver on the transformation. It also helps to have proper reserves that match the level of risk based on the other components of the business plan. Investors must troubleshoot what could go wrong with the deal and decide how to mitigate these issues moving forward. The goal is not to brainstorm every doomsday scenario, but to evaluate your potential exposure. Identifying risks and finding options to mitigate them is key to success. Taking a neutral approach to evaluating and assessing risks is very important. Can't fall in love with any outcome is kind of the bigger picture there. Now, while the lending landscape has changed, the appetite to find value remains strong. Those who understand how to identify and manage risks are poised to find great deals during the next cycle. For example, those 3,200 units were sold at auction to New York Group for $197 million, estimated to be at least 30% less than what the previous owners just paid. Now, if you're in need of an experienced commercial real estate broker, I can be reached at 281-222-0433. I appreciate your time and have a good day.